Hey everyone, how you doing? Hugh here. I'm going to do a quick video explaining investment performance from 2020 and putting it into context in some other years, and also giving you a quick reminder of some of the important bits to our model portfolios. I'm going to share screen and do a bit of drawing. Hopefully it gives you an idea of what's happened in the last 12 months and also what's different to what we might have expected. Hey there, welcome back to the channel. If you are new here, my name's Hugh and I'm a retirement specialist and money coach at Proposito Financial Planning, based right here in the heart of the Cotswolds. And on this channel, we explore the strategies, tools and money habits to maximize your life force, that's your time, your energy and your ability, so you can live a life with more meaning and more happiness. Right, let's get into it. Here I am, down the bottom left. So this is a picture of 2015 and shows two parts. The first part is the red line, and the red line is the equity part of the portfolio, and its job is to deliver long-term returns. But as you can see, in a calendar year, it goes flying up and it goes flying down. Now the blue line that you can see is pretty flat. That's the fixed income part of our portfolio, and its job is to reduce volatility. Now we choose the constituent parts of the red line and the blue line very carefully. We choose the constituent parts of the red line to go flying up and flying down, because that's what drives investment return over the long run. But the constituent parts of the blue line are chosen very carefully to be low volatility. And because they're low volatility, that means they have a low risk, and because they have a low risk, they have a low return. Now the only thing that you and I control each year is how much red and how much blue. The stock market determines the shape of these charts, and we don't know what's going to happen from the start of a year to the end of a year, but what we do know is the red line is going to be really volatile and the blue line is going to be pretty flat. So let's have a look at that. In this year, which is 2015, both the red line and the blue line started off in the same place and finished in the same place, but how the red line and the blue line got there was very different. The red line went flying up, flying down, and then flying up again. The blue line went straight across. And it doesn't matter what the year is. This is 2016. Again, very similar. The red line down and up, blue line really flat. And each year is the same. So there's the red line and the blue line just always behaving the same. Now 2018 is interesting because there was a bit of a crash towards the end of the year where there was a bit of a panic about Brexit. But look what happened to the blue line when the market went down in a mini crash. It essentially held its own, and most of the time that's what the blue line does. The red line goes flying down, the blue line stays pretty steady. Doesn't happen all the time, as we'll see in a minute, but that's the role of the blue line, is to reduce volatility when red line's flying down. And also you can see here where the blue line's pretty flat, it doesn't react to that sudden increase, it doesn't react to that increase, and it doesn't react to that sudden drop. So the blue line is doing what the blue line should be doing most of the time. Now it's worth pointing out that typically in any year there's a 10 to 15% drop in the red line somewhere. It doesn't happen every year, but that's largely what you can expect. And you can expect a 30% drop in the red line on average once every 5 years. So that's worthwhile bearing in mind. 2019 again looks the same, and then we come to 2020. So here we are in 2020, everything looking rosy, relatively speaking, 12 months ago, January and February, and then we get towards the end of February and the news of the pandemic starts getting a hold, and the market goes flying down. In the space of just under a month, it's gone down nearly 30%. This was the 23rd of March, and that was widely reported in the news. Billions wiped off the value of stocks and shares. What wasn't reported at all, largely, was this subsequent rebound, this movement sideways but upwards as we were waiting for a vaccine to be developed, and then this bounce back upwards as the vaccine got approved and the rollout started, and none of that got reported. Had it been reported in the same way, it would be billions wiped onto the value of stocks and shares. So that's a picture of what's happened in the red line, the stocks and shares part of the portfolio. Now it's interesting to look at the blue line, Because initially when the markets dropped here, the blue line actually started increasing. So as people piled out of equities here, they started investing into fixed income, and that caused it to increase. Then we got to this point here, which is where panic setting in the market. People piled out here and people piled out here, so the price of the fixed income actually went down. And then it recovered from here, it recovered back up, pretty much in line with what we would have expected. And that recovered much quicker than the stocks and shares, much quicker than the equities. And that shows that the blue line is doing its job as well, which is to reduce volatility in the short term. Obviously that has an impact in the long term, and that's what we'll look at next. So we've looked at what happens to the portfolios when we look at individual calendar years. What happens when we combine those? This is the 5-year picture. So this is what happens to the red line and the blue line over 5 years. And you can see they both start off down here. The journey of the red line is very bouncy, and the journey of the blue line is pretty flat. But where they end up is very different. The red line had a 72% return over that 5-year period, whereas the blue line had a 12.1% return over that time period. And you start to see the benefits of owning the red line for the long term. The more red you have, yes, the more painful it can be when the markets go flying up and down. Certainly in and around the 23rd of March, that was an uncomfortable time for a lot of people. But the more red you have, the more return you can expect over the long run. You get rewarded for taking the risk. That's why these events here are features of the market, not faults with the market. If there was no risk, then there would be no return. So what happens when we look further out? Well, over 10 years, the return's 133%, so more than doubling your money for the red line, and 27.8% for the blue line, which is still okay, still ahead of inflation. 20 years, again, the numbers start getting quite big. So looking at nearly a 300% return as opposed to 125% return for the blue line. The longest time period we've got is 65 years, where the return on equities is 101,000%, which is eye-wateringly large. If you'd have invested £1 way back in 1956, it'd be worth a staggering amount of money now. But there we go. I just wanted to share with you what's happened in the last 12 months and how that fits in to the bigger picture. Just to show you again, that's the chart for 2020. The markets went flying down and subsequently recovered. We don't know what's going to happen in 2021, but what we do know is the journey of the red line is going to be really volatile. It's going to go flying up and down. And what we do know is the journey of the blue line is going to be pretty flat, and it's going to reduce volatility. All you and I can do is work out how much red and how much blue. The stock market will determine the shape of these charts.